The 2008 financial crisis scared a lot of everyday average investors away from buying stocks. Hey everyone, Tactical Timmy here. I wanted to talk about how being scared away from buying stocks and maybe even being scared into buying precious metals, gold and silver can affect us still here today. Before we can talk about that though, we need to have a model of how the actual economy works. And we're going to actually use a very, very classical economic model. And this is something that's been around for a very long time, even back to Adam Smith and the Wealth of Nations time. And the idea behind this model, it's actually called the slow growth model. The idea behind this model is that, hey, everything that's produced in the economy, we have this idea of GDP, and that's all the goods and services added up in the economy, and what is produced is what's called that GDP. That is going to be a function of just a few things. So what actually causes GDP to go up and down? It's a function of, number one, the labor, because in order to produce anything, whether it's gold or silver, or the food that you're putting on the table to eat, or anything else, you need labor to actually produce it. And with that, you have skilled labor, you have unskilled labor, and that gets into a modification of the slow growth model in the future where we introduce the concept of human capital and actually having skilled labor. So we have labor, that's the first thing that you need, and you probably are going to need tools. Those tools can be as simple as, paper and pencil, it can be a computer, it can be a manufacturing machine, maybe it's a backhoe and something that you'd need to dig gold and silver out of the ground or anything else out of the ground to actually produce it. So we have capital and we have labor. Those are the two things that actually cause GDP to go up and down. There's an added on thing with technology, and that's something that we can talk about in the future because technology obviously can change things a lot and increase our productivity a ton. But for the most part, we have capital and we have labor that are the main things that actually cause GDP to go up and down. So we can actually look at changes to these things and see how it might affect us in the future. Let's go ahead and let's go through this in terms of current event situations and see how that looks. So one of the current events that's out there right now is we actually see a whole lot of immigration. And how would immigration actually affect us? Well, immigration is going to go ahead and increase our population, therefore increase our labor force. So in theory, we're going to be able to not just produce one thing, we're going to be able to produce a whole lot more of it. We're going to have lots that we're able to produce. And with that, we are going to be producing more, so our GDP will be going up. But that doesn't necessarily mean that our standard of living is going up. And why is that? Well, as we increase population, we will find that the amount per person actually is going down. So if the population was, say, 4, and we normally were getting 2 of these per person, well, all of a sudden, if our population doubles, then all you're going to be getting would be 1 per person. So that is one of those interesting concepts where just because we're increasing GDP doesn't necessarily mean that our standard of living is going to be going up. Let's take a look at another example, and maybe let's specifically take a look at that example that we talked about before. After the 2008 financial crisis, at the beginning of the video, we talked about how we actually saw people stop investing in stocks as frequently. And what that actually has resulted in is a decrease in savings and investment. Well, if you're investing in capital that actually would grow the ability for us to produce more things and would actually therefore grow GDP, we would see that if people don't invest as much in capital, they're going to not be able to produce as much in the future. Now, granted, if you bought a certain number of backhoes back in the day, that's going to last for a long time. But if you don't have the capital to replace those backhoes when they actually are damaged or have something wrong with them, those backhoes are eventually going to depreciate away and not be actually worth anything. So we have this idea that hey, our savings and our investments need to make sure they're keeping up with this depreciation. So what does that actually cause? So if we see that after the 2008 financial crisis, people kind of lost faith in the system and they stopped investing in these stocks and they started investing more in, gold and silver and that kind of thing because they just didn't have the faith in the financial system. Well, we actually might have seen a decrease in the actual GDP because of it. Now, we actually didn't see a decrease in GDP significantly, and a lot of that is because the United States has a huge capital stock. I gave the example of backhoes earlier, and we have a ton of different resources and different things that will continue working into the future with just a minimal amount of capital investment. So you'd probably see a continued growth in GDP, even though we aren't investing quite as much as we have in the past. And that's an interesting concept because it's not necessarily going to be a short-run growth model. This slow growth model is actually only effective in the long run. So we saw after 2008 the dip in people's ability to buy these stocks. But we have slowly seen that kind of come up over the years, and people have gotten more and more comfortable with investing in stocks. And you still see some people that were investing in gold and silver, but I'll be honest, a lot of people got into investing in gold and silver, and then in this year, 2011, when we saw that spike in silver, a ton of people were interested. But then once it fell back off after that silver squeeze, we saw a lot of people get out of precious metals investing and start investing in stocks again. Now, on this channel, I'm always a believer in having a base of precious metals and not just completely getting out of precious metals investing. But I also feel that it's really, really important for us to also invest in stocks. Having that balanced and well-diversified portfolio is something that's not only going to give us the best return, but it's also going to be the best for our country. Having a stock of gold and silver is a reserve capital that we can use to actually produce things in a time of need. We can go out in a time of need and use this gold and silver to purchase the things that we need. Now, conversely, we probably shouldn't be Scrooge McDuck and just sitting on a huge hoard of gold and silver and never actually using that gold and silver to create things in the economy. We should be starting businesses, we should be supporting businesses, and going out and actually trying to create and get better at creating things. That's something that's really, really important for us to do to grow our GDP per capita. And notice how I said GDP per capita, because that's what we really should care about when it comes to our economy. We shouldn't care about just growth for growth's sake, because if you're growing, but you're also growing your population, well, that means that you're not actually growing. You're staying the same. And if your population's growing faster than your GDP can actually grow, well, you're actually going to experience a decrease in your standard of living. So I hope that you found this use of a model, an economic model, and this was the slow growth model if you're interested in looking it up. I hope you found this interesting, and I think that using some of these basic economic models, I know we've talked about supply and demand in the past, and now we've talked about the slow growth model. Some of these very basic classical economic models can actually help us take a more level-headed and balanced approach to our precious metals investing and can kind of keep us from fearing and getting into that doom and gloom cycle and have us have more realistic investing approaches. So if you would like me to analyze any other current events or anything else that you've noticed in terms of your silver and gold investing or your stock investing over the years, I would love to try and apply some of these different economic models to those different events, because I think that that's something that makes it a much more level-headed and doesn't just have us get into the mindset that, hey, silver is going to the moon, and it's actually not going to be the case all the time. We have to have the level-headed approach to our investments and make sure that we are diversifying our portfolios. Take care, everyone, and I'm so glad that you joined me on this silver and gold video.